Ben, I'm going to welcome you to the Capital and Powerverse, because I have noticed that you start your podcast and your videos with welcome to the Cryptoverse or the Macroverse. So welcome.
Thanks for having me. It's a pleasure to be here.
Let's get right to the question. I think a lot of the people who are using Invest to make decisions, especially those who are interested in Bitcoin and crypto, let's get right to this question. Where do we stand at this moment in time? It's August 2025. We've seen Bitcoin hit about 120,000. But where do we go from here? I've got one guy who says we're going to hit 200,000 by the end of the year. But this old timer is saying, yeah, show me.
Look, I'll say anything's possible with Bitcoin. What I would say is that normally the peak for Bitcoin occurs in Q4 of post-halving years. So, like, for instance, last cycle, we saw Bitcoin top out in November of 2021. The cycle before that, it topped out in December of 2017. The cycle before that, it topped out in November of 2013. So I do think, while there still might be some upside, I think that, it would be prudent for people to remember that, wherever Bitcoin is trading a few months from now, whether it's 120K or, as your friend says, 200K, that's likely going to be, around the top for the market cycle. And there's actually kind of an interesting chart that I can show you to sort of provide some evidence for that. And that's this chart right here. It's the ROI of Bitcoin as measured from the bottom. And you can see the last two cycles are these green and orange lines. And here we are right now, this sort of like this purple line. So I think it would make sense to expect diminishing returns. If you add on, other cycles as well, you can see that we have diminishing returns. And there is some reason to actually combine cycle 1 and cycle 2 because they only overlapped on one halving cycle. So if we do that, we can actually see what that looks like. But the point is when you just kind of look at the last two cycles and look to see where we currently are, we're currently on about, as measured from the low, we're currently on about day 996 of this cycle, day 996. And last cycle topped out on day 1059. And then the cycle before that topped out on day 1067. So, really, I would argue that come Q4, I think people should be a little bit more cautious on just how much higher it can go. Again, there still could be room for the upside between now and then, but once we're in Q4 of this year, I think it would start to make sense about, kind of thinking about, all right, let's prepare for the midterm year. And as we know, in the midterm years, that's when Bitcoin normally, unfortunately, goes down for whatever reason, right? And I think that's sort of what it makes sense to prepare for starting in a few months. So, look, I don't know exactly how high it's going to go. I think it makes more sense to know which way the wind is blowing. And I think we're going to start to see some of those headwinds starting in a few months.
So let me break this down. And first, my apologies to the viewers who understand crypto far better than I do. I am a Luddite when it comes to this stuff. I mean, I'd probably still be using traveler's checks if they existed. But what you just showed us, as someone who is full-on capitalist, loves the idea of being able to make money, looking at some kind of technical analysis, what is the expected drop once we reach that moment, whether it's in 1,067 days, days for the Bitcoin peak or 1,051, how far does it go down in these cycles?
Yeah, that's a good question. So in the same way that we've had diminishing returns, right? So if you measure, just going back to that chart I showed a minute ago, right, you can see that every cycle gives a lower return. That's, a lot of people don't like that, but it just takes exponentially more capital to move, a market cap that's just that much higher. In the same way we experience diminishing returns, we also have diminishing losses in bear markets. So, for instance, if you go look at, say, the first bear market, it was about a 94% drop, which seems insane, right? And I mean, obviously, anyone invested in the S&P 500, like the idea of a 94% drop is just like not even tenable in their mind. I think like just
catastrophic,
right? I mean, it's catastrophic. But as Bitcoin has matured, the bear markets, while they have still been brutal, they've gotten a little bit easier to manage. The second bear market was around an 87% drop. Still bad, right? Still bad. The next bear market was around an 83% drop, 83, 84%. Last cycle, it ended up only being about, and I say only, but it ended up only, quote unquote, only being a 77% drop. So, I would argue that the next bear market is probably going to be maybe around a 70% drop, plus or minus a few percent. Now, that might sound ridiculous, right? It might sound ridiculous, but when you view it through the lens of the entire cycle, it's really not, because like if you look at Bitcoin, from the low, it's actually up 640%, right? The S&P, on the other hand, we know bottomed at around 3,500, 3,400, 3,500 back in 2022. Like, it hasn't even gone up 100%, right, since then, because it hasn't actually hit 7,000. So while it's true that the S&P likely won't drop as much as Bitcoin whenever you have a future bear market, we also have to remember that Bitcoin went up a lot more than the S&P 500 in the bull market. So, for instance, in this case, let's say Bitcoin were to drop 70%, and I don't know exactly where from, but let's just say, 135, okay? If it were to drop 70% from there, that would put Bitcoin at 40K, which again, this is a pretty, this is a more bearish scenario, suggesting it could only go up that amount more, and it could very well exceed that. But even in that case, if it were to drop 70% from that level, that's still up 146% from the low in 2022, which still outperforms the S&P 500, right? And so that's the thing with Bitcoin, right? In bull markets, it behaves like a tech stock, like a really, much more volatile version of a tech stock. It goes up a ton. You just got to be aware that in the midterm years, Bitcoin tends to go through a bear market, and it gets wrecked, and everyone says, we told you so. And then in the next bull market, it just outperforms most everything again. So, to answer your question, I think the next bear market would probably be about a 70% drop from whatever value it's at in a few months.
And that bear market, if the past is an indicator, is within the next 2 months, the beginning of the fall.
I would say it could start as early as late Q3, or it could start as late as late Q4, right? I mean, I think the window would probably be, sometime in the back half of the year. And again, it could go until November, December in a better case. A lot of it kind of depends on how well the macro holds up over that time period, like the labor market, inflation. How long does that hold up?
Did you see the labor report on Friday, August 1st? Don't go there yet.
There's a lot of revisions to the downside. But again, the market, while there were a lot of revisions, the market the S&P tends to go up until it really has a reason not to. And while the report certainly is leading to a temporary drop, that doesn't necessarily yet mean like it has to be the big one, right? Like there could still be some, a little bit of, maybe we get a rate cut in September and that reignites things for a couple of months, right? It's hard to know, but yeah, I mean, It seems like something's coming at some point within the next 12 months.
Okay. So let me pause. I want to talk to you because you brought up two issues here, but I want to talk to you about correlation between Bitcoin and other cryptocurrencies and traditional markets. But I've got to ask you this up down step, the step ladder trend up. At what point does that stop being the expected cycle? Because as we get to the point of not being able to generate new Bitcoin, wouldn't that artificially or appropriately drive up the price because of scarcity?
Well, we're not going to reach that point until the next century. So I think it'll be more my, something my grandchildren might have to contend with. I do think that, like, the 4-year cycle at some point in the future will break. But we also have to remember that the 4-year cycle is not just a Bitcoin thing, right? And I will kind of show what I mean and show you kind of in the past occasionally how it can break, right? Like it's a thing that can last for a while, doesn't mean it's going to last forever. So for instance, with Bitcoin, what you'll notice is that the lows are about every 4 years, right? This is like 2014, 2018, and 2022. So you have these lows approximately every 4 years. And then of course you have the low in 2010 as well. So, right, so every 4 years, 2010, 2014, 2018, 2022. This is not the first time we've seen this. We've seen it in the S&P 500 in the past before as well, and maybe it's tied to sort of like the presidential election cycle. Not exactly sure, but for instance, if you look in the 1970s, right, we had these 4-year cycles. In 1962, a low, and then 1966, and then 1970, and then 1974, and then 1978, and then 1982, right? So we've had 4-year cycles in the stock market in the past, but occasionally, you know, that breaks, right? And you get, like, I mean, look at the financial crisis when that happened, right? That low did not occur in, say, a midterm year, like a lot of the other lows. So while I do think, you know, I sort of operate under the assumption if it's not broke, don't fix it. Like I'm not going to try to outsmart the 4-year cycle because I think I'm a smart guy, right? I just, you know, sort of bow to the market and say, look, this is what it's always done, and I'm going to assume it's going to keep doing that until proven otherwise. I'm guessing that at some point otherwise will be proven. But again, you know, I don't want to call for something like that. And just wait for that one time where it actually turns out to be correct. So I mean, for me, I still just believe that the next low will be kind of near the end of 2026. Obviously things could change at some point, but that's my general expectation. And you know, over the next like 30 years, we're probably going to see at some point in one cycle or more than one, we'll probably see a breakdown of that, you know, consistent trend. But in order for that to break down, you probably need some, you know, really bad economic catastrophe or something, right? I mean, it takes something big to break something like that.
So that economic catastrophe, you know, stable coins and the way they're going to amplify perhaps risk and exposure might lead to that. And we're going to talk about that. But I want to just reiterate with Bitcoin because I have family members who got into Bitcoin. I mean, I could have got into Bitcoin. Coulda, woulda, shoulda, right? Back when it was, you know, like $100. Didn't, because I'm the old timer. But what I heard you just say is if you're looking at Bitcoin today, why buy at these prices? Wait for the correction. What do you say to those people who are still jumping in, buying at $118,000, $119,000?
Well, I mean, I think the argument is that, you know, no matter how smart anyone appears to be, no one actually knows what the markets are going to do. Another case to be made is if your friend's right and Bitcoin runs 200K, you know, a 70% drop might not actually be that much lower than the current prices, right? I mean, if it runs up a lot. So, I guess that's sort of the counter argument that like no one actually knows. And a lot of times near the end of bull markets, Bitcoin will go up a little, you know, it'll go up a lot very quickly. And that kind of is what sets the sell pressure for the bear market. It's kind of, you know, that last major thrust to the upside that then everyone, all the long-term holders sell to the short-term holders, and then they wait a few months to buy back in. So I guess the argument would just be that no one actually knows what's going to happen. And also, I mean, the other thing too is if you look at you know, the way this cycle has gone, it has felt, in a lot of ways, this cycle has felt a lot different than last cycle. It feels more like the 2017 cycle, right? Where basically in the 2017 cycle, Bitcoin really was the main reason the market cap went up so much. Like Bitcoin was the main one. Last cycle, it was a lot of altcoins really outperforming because we had quantitative easing and we had, you know, zero, you know, interest rates basically at zero. Now we have much higher interest rates. And so you could argue that a lot of the capital coming in is actually more so geared towards Bitcoin than being distracted by going into a lot of other cryptocurrencies.
Would you buy Bitcoin today at these prices?
So what I generally do is I buy it whenever it goes either below the 0.4 risk level or the 0.5 risk level to give you an idea of where the risk on Bitcoin. And this is just something I created, right? It's just something that I use. The current risk on Bitcoin is about 0.57 or so. So, I mean, it's a little high for me right now. If you look, I can actually share my screen so you can actually know what I'm talking about instead of me just rambling here.
I think this is incredibly valuable, even for someone who doesn't truly understand it.
Yeah, so like this is the Bitcoin risk metric that I created this back in 2019, and the idea was, look, I don't know where Bitcoin's going to go, but whenever it goes to low risk, I want to buy, and whenever it goes to high risk, I want to sell. And so back then in 2019, when I presented this risk metric, I said what makes the most amount of sense is when it goes below 0.5 risk. That's when you want to start just DCAing blindly into Bitcoin, right? Anytime it's below 0.5 risk, I buy. If it's between 0.4 to 0.5, I might put in, and I'm just making up a number, right? Maybe I put in $100 or something. And again, I'm just throwing out random numbers just so we can think about it. Or maybe I put in X amount. If it goes down to say 0.3 to 0.4 risk, then I would put in 2X, or say like $200, right? If it goes down to 0.2 to 0.3, then I would be putting in $300, right? So the idea is that I weight my buys at lower risk levels, but then I also do the same thing to the upside. So like if, for instance, Bitcoin goes to 0.7 risk or something, I might sell 1/10 of my position. If it goes to then 0.8 risk, I might sell 2/10 of my position, and so on and so forth until you go to those high risk bands. Because the problem with Bitcoin, the volatility, is that no one actually knows when it's going to make these runs to those higher risk bands. Like no one actually knows when it's going to happen. But what's important is whenever it does happen, take advantage of it, right? Don't just sit there and fall into the camp of like, oh, it's going to keep going up forever. Just make sure you recognize that when that happens, it likely is a market cycle top, and that there will likely be a lot of sell pressure until we get back down below that 0.2 risk level. So that's kind of how I navigate it. Anytime it gets a little heated, I might skim a little bit of profits. If it goes below a certain risk level, I might buy a little bit. Right now, it's kind of in between. Right now, I'd say it's in kind of like the gray zone for me. Like between, 0.4 to 0.6 or 0.5 to 0.6, between those risk levels, like I'm not really buying Bitcoin, but I'm also not necessarily selling it either, right? It's kind of in that.
But what's the overall performance of that strategy you created back in, did you say 17 or 19?
So I created it in 2019. So I mean, it beats. I did a video on it a while back. It beats a normal DCA strategy because it allows you to weight your buys closer to lower risk metrics if you actually have the patience for it. And I also think it's better than just for crypto. So for the S&P, lump sum has always been the best strategy, right? And I think anyone who's been around in the traditional markets for a long enough period of time would agree that, like, lump sum tends to work out because it's more so like time in the market beats timing the market. With crypto, because you do occasionally get these like 70 to 80% drops in the midterm years, you don't want to be the guy that lump sums at the end of the post-halving year, right, or the post-election year, because usually that ends up being the market cycle top, and if you do that, then you have to wait 3 to 4 years just to get back to break even. So with Bitcoin, DCA, I think works a lot better, especially if you can stick to the risk metrics, right, and say only buy when it's at low risk levels. Try to weight your buys at low risk levels when no one wants to buy. And then when everyone's screaming, don't ever sell, that's when you want to sell, when it's up these higher risk metrics. Off the top of my head, I don't have like a number for you, but I have done some videos in the past where we sort of looked at this strategy and compared it. I think we have a tool here. It's called DCA Strategies, where you can go in and basically see, the dynamic DCA, right?
You can back test.
What?
You can do a back test. You can see.
Right. So we have this dynamic DCA tool. Let's say we started. Let's just go back to 2019. Like, why not? That was when we launched it. I created my channel. I think I launched it in like November of 2019, because I created the channel in June, and I think I launched this in November. So let's just go back to November of 2019. Let's just pick about mid-November, and then just say to today, if we put in, $100 every week, that's our X. But let's say we weight it by dynamically doing it up to 0.499 risk, then you basically would have invested $29,900, and now it'd be worth about 10x that, right? If you were only investing $100, right? Obviously, if you were investing $1,000, right? I mean, it significantly increases that, and that's also weekly. And so, this, and you can kind of see like what it says right here. Like, you would buy 1,000 in this risk level, 2,000 here, 3,000, 4,000, 5,000. So that more or less shows you an idea of what your returns would be. I think there's a way, it's been a little while since I've looked at this, but I think there's a way as well to compare. Like, you can actually compare it to other assets, right? So like,
Well, let me
yeah, go ahead.
the tools that you're showing us, these are to your clients, the people who log in and subscribe to Cryptoverse, correct? Or can I, as a Luddite, and is it free? Because I love free stuff.
I think I'm not 100% sure. I think the DCA simulation is free. I think the dynamic DCA is not. But I think if you just want to go in and say, all right, and maybe I'm wrong about that, but I'll double check. But I think if you just want to go and say, all right, well, if I bought $1,000 of Bitcoin every week, for the last 6 years, what does that get me, right? You would have invested $278,000 and it would have netted you, 1.4 million. You can see how different that is than the dynamic DCA, where it would have netted you, 2.1 million had you done like a similar type of strategy. But you can also compare this. I'm pretty sure this tool is free on the website. You just have to provide your email, I think. But you could compare it to, say, like another coin, right? Like, you want to compare it to Ethereum and see, what your performance would be in that case, and it'll kind of show you here, what your ETH portfolio would be versus your Bitcoin. So coincidentally, if you just were DCAing $1,000 into Bitcoin every week for the last, let's call it 6 years, versus doing the same thing for Ethereum, with Bitcoin you're up about 421%. And then with Ethereum, you're up about 388%. So Bitcoin gave you slightly better returns over that time period, but if you bought ETH, you're also not hurting that bad.
Do you have a mathematical strategy as to which of the currencies to choose? Everyone loves Bitcoin. Well, I don't know if everyone loves it, but Bitcoin is clearly the giant. But then you have these different kinds of coins and these different kind of currencies, and the strategies that you're sharing with us, I can't imagine that they are, cumulative, that they work for everybody.
Yeah, so there's two things I would say. So the more narrative-driven approach is just that when the Fed is raising rates and keeping interest rates high and going about quantitative tightening, you're better off in Bitcoin than the altcoin market, right? That's the assessment. And that's proven by just looking at Bitcoin dominance since the Fed started raising rates in March of 2022, right? And that was around the time that quantitative tightening started. So that would have been a good time to be mostly in Bitcoin rather than the altcoin market. And if you look at altcoins, their valuations against Bitcoin, you can see that they tend to bottom out whenever the collective market cap of altcoins is 25% of Bitcoin's market cap. Sometimes it wicks lower, but whenever they're about 25% of Bitcoin's market cap, that's when altcoins potentially bottom against Bitcoin. But until that happens, it just makes more sense to fade altcoins on their Bitcoin pairs because they just keep on going lower and lower and lower. So Bitcoin is just sucking that liquidity out of the altcoin market. And I think it's going to continue to do that for at least a few more months, even though I think some coins like Ethereum maybe already bottomed on their Bitcoin pairs. But the mathematical strategy that you asked for is this tool over here, which I'm pretty sure you're probably familiar with modern portfolio theory. A lot of people use this for classical or just traditional investing. Basically, we can calculate out, our Sharpe ratio and our Sortino ratio based on what the markets have historically done. And then we can say, well, I don't care what, this influencer tells me what position I should have. I just want to know what portfolio percentages between, say, Bitcoin and Ethereum, what would maximize my risk-adjusted returns over a long period of time, right? And so I prefer the Sortino ratio because it does not punish positive volatility, and it would suggest about 83% Bitcoin and about 17% ETH would be the portfolio that would maximize your risk-adjusted returns. Now, look, if you add an altcoin, we can add an altcoin. Let's add Litecoin or whatever, right? We can add an altcoin, and then you can see how this changes. What you want to do is you want to make sure your portfolio is on this green line up here, which is called the efficient frontier. Because what it means is that your expected annual return for that portfolio is, say, like, let's say you pick it right here, your expected annualized return is 70%, but plus or minus 75%. Every few years, every 4 years or so, you have a really bad year in the cryptoverse where like the markets go down 70, 80%, but then the other years more than make up for it. But what you'll notice in this case is that if you add Litecoin into the mix, Litecoin, the recommendation, not based on me, not based on my bias, or my bags or whatever, the recommendation is 0% Litecoin. And the reason for that, the reason is very clear. All you have to do is you have to look at the Litecoin valuation against Bitcoin, and what you'll notice is that it just goes down over a long enough period of time, right? So, like, we're not saying that Litecoin won't go up on its USD valuation. It very well could, but why celebrate Litecoin going from $50 to $100 or $100 to $200 when Bitcoin went up, 10x over that same time period? So again, the risk-adjusted returns is the mathematical approach to help people pick out, what do they want in their portfolio versus what they don't. And I can take one look at this and say, well, why would I hold Litecoin in my portfolio? Because not only does it bleed against Bitcoin, it also bleeds against Ethereum. And the math supports having no Litecoin because Bitcoin and Ethereum are going to outperform it.
This question may be very in the weeds, and it may be the kind of thing that you don't want to answer. And this is an interview, not an inquisition. Among your client base, I mean, you've got 1 million plus followers. I'm not even sure how many of your clients, if you disclose those numbers, but among the clients, do you track how they are utilizing the tools and their potential success rates? Is there a way to quantify that?
So we do track like the pages they visit the most. And one of the pages they visit the most are the risk levels, right? Like the risk levels for the different cryptocurrencies. They're really interested in that, right? So like if you look at Ethereum, you can see that the current risk on ETH is 0.65. And
let me stop real quick. If I'm watching this and I'm knowing that the majority of clients are going to a certain kind of page, does that give me something valuable upon which, actionable that I can use?
Well, I mean, I think that I still think that the number of people using this is pretty small compared to the overall number of investors in crypto. I use it because it keeps working, and despite every cycle, people saying that it's going to be different, it just keeps on working the same way over and over again. And it actually just worked for Ethereum again, because the thing that Ethereum always does is after it goes to its regression band, it bottoms against Bitcoin, and when it does that, the risk level on ETH goes to 0.3 to 0.4 before it breaks new all-time highs. It did it in 2016 right here. It also did it in 2019 here, and then now it just did it again in 2025. So whenever that happens, it makes sense to get bullish on the ETH Bitcoin pair. And the thing about it is I've published this analysis over and over and over again on YouTube, where I said this was what's going to happen. I said that Ethereum would go to its lower regression band, and when it does, that's when the ETH valuation against Bitcoin bottoms out. And what's crazy is how many people told me how crazy I was and how it would never happen. And, I have a lot of followers, but a lot of people will also disagree with me. And there are times where I get things wrong, right? Absolutely. There are times where I get things wrong and I have to lick my wounds. But, just because a lot of people are looking at it doesn't mean it won't happen. And this is a great example of that, of showing a narrative of, hey, look, when ETH goes to its regression band, that's when this blue line over here, that's the ETH Bitcoin pair, that's when it bottoms. And once again, you can see it's played out just like it played out the last couple of cycles. So, I mean, I guess we could argue that if people are looking at it, it won't actually happen, but it's been working so far for me. So I'll keep using it until it doesn't work.
All right, let's take a quick, breather, step back from this, because then I want to talk about what's going to happen with stable coins and its impact on all of this. But how did someone like you, I joked with you before I actually started recording, you're a NASA rocket scientist, get into this? Was it the mathematics? What is it that draws you to this, or the potential to become incredibly wealthy?
Yeah, I mean, so I first, my undergrad was in mathematics, and I took a cryptography class my junior year. That was also when I did my internship at NASA Johnson Space Center, and I got into cryptography. And so just naturally by an extension of that, I got interested in Bitcoin through that class, and just thinking about a distributed public ledger, and just being able to the transparency that comes with it. I got interested in Bitcoin back then. And then I would the problem that I had back then was that while I was very interested in it, I didn't actually have any money because I was a college student, right? I mean, this was back in 2011, and I was a poor college student, with student loans, right? So then in grad school, I actually had a stipend, and I also got married before I went to grad school, and then I remember just a lot of us grad students just being interested in it for the technology. It was mostly more the technology back then, because we didn't have all these, we didn't have a decade of all this price appreciation, right? Like the price of Bitcoin back then was $200, it was $200, $300. While it was still impressive to us back then, because we had seen where it was before, it still wasn't like we knew it was ever going to get to this point. And so, we got interested in it, and then obviously when the price goes up of it, you just become more interested because you're already interested, and then if you own some of it and the price goes up, it's hard not to pay attention, because if you make a good investment, it can change your life, right? I mean, it can change your life no matter who you are. And so I guess that was what kept me. And then throughout those first few years, I made all the mistakes. I put a lot of money into altcoins, and then I would watch those altcoins just bleed back to Bitcoin over a long enough period of time. Even though they might go up against the US dollar valuation, I would just watch them bleed against Bitcoin. So then eventually in 2019, I graduated with my PhD in 2018, and then I started a postdoc at the National Labs in 2019, and I was like, all right, well, maybe since I've learned all these lessons the hard way, why don't I just make a YouTube channel and try to educate other people? Still, at the time, I had no vision of starting a company out of it. I was just doing it for fun. I was an academic. I was working as a postdoc in high energy density physics, right? This wasn't something that was on my bingo card. If it had been, I don't know that I would have gotten a PhD and done a postdoc. I mean, it just would have seemed like I'm going down a completely different route. And when I started, I eventually started the company because I realized there was a much higher demand for it than I initially realized. And then it got to the point where I was doing both, right? I was working as a postdoc, and I was running this company. And of course, I had to disclose it to the labs and whatnot. I had to disclose what I was doing, but it got to the point where I realized I couldn't do both anymore and do a good job at both, right? Like if I do something, I want to do it well. I don't want to, just put half an effort into it and call it a day. I want to do it well. And I just felt like this job that I'd worked my whole life for, while I was working, doing that job for a few years, I couldn't justify taking that job away from someone else who might actually focus, who might actually be a little bit more focused on it than I was at the time. So I decided to just take a risk. I quit the job. I felt like I was an idiot, honestly.
What'd your wife say?
It was hard. It was really hard. I don't remember exactly what she said. I mean, I think she was supportive, though. I think she was supportive. I think we were both a little nervous because we didn't know, what the future held. And then we've had all those crazy years since. I mean, I don't regret leaving at all. There are times, though. There are certainly times where I kind of wonder, what's next. I don't necessarily just want to only do this for the rest of my life. I wouldn't mind getting back into, other types of things like engineering. Like my PhD was in nuclear engineering. I wouldn't necessarily mind getting involved in some way in other roles, but it just hasn't. I just haven't really had the opportunity to do that just yet. But it's something I'll probably do as I get older. I might branch out. Maybe I'll delegate more things in this company to sort of give me a little bit more free time to do other things. But that's kind of how I got here and what kept me around.
suspect that the company and what you're doing has, if not made you wealthy, has made you comfortable. But what's the payoff personally for you? Is it that, or is it something else?
So originally, before I was even, before the company was making any money, originally the payoff that kept me doing it was just the appreciation that people would show. I just thought it was cool to be able to say, like, look, this asset looks really attractive at these levels, and then to watch it go up a lot. And then people say, hey, I was able to, to pay off my student loans, or I was able to buy a house, or whatever, right? And then they would say thank you. That obviously made me feel good. And also at the time when I was working as a postdoc, like the stuff I was doing was so specialized that even though it was important, only like 2 people in the world probably cared, about like what the very specific thing I was doing, or could even understand that exact, like why it was important, And I just felt like I wasn't having as big of an impact as I wanted to have on, just on people. And therefore, like, this thing gave me a way to have a bigger impact on people in general. And now that I've been doing that a few years, I guess I have started to think about, well, how could I have an even bigger impact? Like now that, I have a lot more freedom, I've made a lot of good investments over the years as well. How do I have bigger impact than what I've already had? I went from the academic with my head in the books to this, and I guess I wonder what's next.
Okay, so let's get back to cryptocurrencies and stablecoins, and I want you to respond. In my trajectory, and you make me feel very old pointing out that you were in high school during the great financial crisis, which I covered at the U.S. Treasury. When you hear so-called knowledgeable people, Jamie Dimon now embraces cryptocurrencies and Bitcoin, but I think, was he the one who called it shitcoin? Was that Warren Buffett? I mean, when the critics say
a lot of them have said negative things about it over the years.
So I'm not going to dispute there's value. There's absolutely value. And then, when my peers say, yeah, but it's a man-made asset, I said, most assets are man-made. What the hell does that matter? But these predictions that we'll be using it to trade and buy at the grocery store hadn't happened yet. And there is a great deal of criminal activity associated with this stuff. I mean, there's a reason the North Koreans demand ransom in cryptocurrency and not in fiat currency. So what do you say to the critics? It's not necessarily shitcoin, but it does do these other nefarious things.
I mean, I think there's crime in every currency. I do think there's a lot of crime in fiat currency as well. The thing about Bitcoin is that it is a public ledger, and so a lot of times when assets are on the move, you can actually track like where they're going. There are some privacy coins that protect you against that, but that's different than Bitcoin. So I would almost argue that a criminal would almost probably prefer fiat over something that can be tracked, like Bitcoin. And now there's a whole industry popping up now of all these like on-chain analysts that track a lot of these hacks, and a lot of times, these people that steal cryptocurrency, when they send it to an exchange to cash out, the exchange will actually freeze the account because it can all be tracked. And again, like, yes, is there crime in crypto? Yeah, absolutely. Because I mean, it's just, there's a lot of money moving around. It's going to attract people who want to do nefarious things. But as a percentage, I don't have the numbers in front of me to be able to prove this to you. But as a percentage, I would probably say that there's probably more crime in other currencies than in Bitcoin. And maybe you would disagree with that. And I would argue that, if you were a criminal, I don't even know why you would want to do it in a way that it could be tracked. I would assume you would want to maybe do it in a different way. So that's more or less what I would say to some people.
So I would say take a look at Congress and insider trading. That's easily trackable, but that goes on. But I won't go into that side of this.
Right.
When you talk about
the point is though is like there's a lot of bad stuff that goes on with in U.S. dollars and fiat currencies. Just because we can point a few things at Bitcoin doesn't mean that's the main attraction for it.
But I thought the original attraction to cryptocurrencies, and we've got to get to stablecoins, but I thought the original attraction was that it wasn't trackable. I mean, you had the on-record ledgers, but that the government couldn't track you, and now you're telling me that they can.
Well, I mean, if I have a wallet and I publish that wallet, then people can track what I do. If you think about like Michael Saylor, one of the things that people have asked him about a lot over the last few years is proof of reserves. And I was actually, one of the things he said recently, and I mean, honestly, like, I think it would be a good thing for him to, show proof of reserves, like show where the Bitcoin is. His response is basically like, if they show the wallets where all the Bitcoin is, and then they move it around for whatever reason, they don't want to lead to panic in the markets that, like, people think they're going to go sell it or whatever. But I mean, the reality is like a lot of this can be tracked, and I mean, there's been a lot of cryptocurrency crime has been tracked because it is a distributed public ledger. You can see every transaction. It's not like we're in an alley somewhere and someone's handing someone like, thousands in cash. That stuff doesn't go on with Bitcoin.
Do you see, I remember at the beginning of all of this, there was a bar down in the financial district here in Manhattan, where you could buy drinks using Bitcoin and, derivatives of it. Do you see that day coming? Didn't is it Ecuador? I forget which country attempted this,
Yeah.
but it seems to have failed in that regard. As an asset, great, but as a means of exchange on a daily basis, I mean, walking to the grocery store, that day's never going to come, or is it?
I think you're right. I think your assessment is right. I don't see that day coming, at least not anytime soon. But there's a very clear reason for it in my mind. The reason we spend fiat is because we know our fiat currency is going to be worth less tomorrow than it is today, right? Because of inflation, right? So we're incentivized to spend US dollars because we know if we just hold on to US dollars, the purchasing power is going to go down. I mean, look at the purchasing power of the US dollar over the last century. It's just gone down a lot. The reason why I don't think you're going to see a lot of people using their Bitcoin to go buy coffee or go buy groceries is because when people buy Bitcoin, they buy it because they think it's going to be worth more tomorrow than it is today, right? And so if you think something's going to be worth more in the future, then you're more so incentivized to hold it and to hoard it. For an economy to work, I mean, again, and this gets into a whole other argument, right? But I think for an economy to work in a normal, and at least in the way we think about them over the last many centuries, you almost need something that's going to incentivize people to spend money, right? Like if we were in a system where it discouraged spending, then people aren't going to go, they're not as likely to go out to businesses and different places and spend their money and just kind of keep the economy going if they were in fact instead sort of encouraged to hold everything that they make. So with Bitcoin, I think the reason we're not going to see that is because people think it's going to be worth more tomorrow than it is today. Therefore, they're likely not going to spend it. And then the other thing is, I think Americans in general, including and especially myself, we're so used to denominating everything in US dollars that it's hard for a lot of people to value things in other currencies. Like I just feel like I meet a lot of people in the States, and when you think about like a currency conversion to euros or the pound or the yen, they're not used to thinking in that way. They're used to just thinking in terms of US dollars. But if you go over to other countries, like in Europe and in Asia, they're more likely to do that, like thinking in terms of that. And so I've noticed that people overseas have been more likely to spend their crypto on other things because their mind is already trained to think in terms of like there's not just one base unit of account that you use. But in the States, I think everyone mostly just thinks in terms of US dollars.
So I'm going to share something with you about stablecoin. I will get it wrong perhaps, and then share, correct me, but tell me where the dangers may lie. And what I'm getting at is, so we have stablecoins pegged to the US dollar, for instance. Banks will now allow you to trade your cryptocurrency or your altcoins, whatever you've got, in exchange for the stablecoins, which you could then use to go buy more of the cryptocurrency, which you could then use back at the bank to get more stablecoins. And this is going to increase or leverage up the risk level for those holding the cryptocurrencies. So my experience, having covered the great financial crisis, is that the geniuses on Wall Street will figure out a way to turn those holdings of cryptocurrencies into investment vehicles and derivatives that they will then have tranches, and there will be shit that they will sell to unsuspecting people like me, although I'm not going to buy. and it will just lead to another financial crisis. When I read these articles about the dangers of stablecoins and then what I think I've described as one of the dangers, is that on target? Is that wrong? Where do you stand with that?
Yeah, I mean, anytime you get a lot of leverage traders, like you always start to run the risks a lot higher. And that was kind of going back to what we talked about earlier, right? In order to break the 4-year cycle, you need some big economic catastrophe to happen. And obviously, as people get levered up more and more, the odds of something like that increase. The difficult part, though, is timing that, because like it's easy to see the risk, right? It's easy to see the risk there. Like in 2021, I mean, I think anyone who had who had a good head on their shoulders could have looked at Luna and the 20% interest that the stablecoin was providing, and anyone who had any neurons firing at all would know that that was a bad thing. But it still took a long time for the market to actually care about that, right? Like, because you could see that was happening in 2021. Market didn't actually care until 2022. But again, and the reason why I feel like people got lost there was they thought, mistakenly, that, oh, us smart guys over at crypto, we figured out how to get 20% risk free, right? Which makes absolutely no sense. But a lot of people fell for that trap of thinking that they could get 20% risk free. And the thing that I think a lot of people need to recognize is that if you're in crypto and there's a product promising you way more than anything you could get in traditional finance, there's a good chance that that product is a fraud, right? Because the people in TradFi, they've been doing this for a long time. They're probably going to know that that stuff isn't sustainable, and a lot of people in crypto had to learn the hard way. So you're right, the leverage stuff.
Okay, so the premise of my question is accurate, but here's the you talk about the cycles being 50 plus. I've seen these cycles. The last time it was, the geniuses in finance giving loans to people who had no income, the liar loans. There was I love the name of this, the Bear Stearns High Grade Structured Credit Strategies Enhanced Leverage Fund. There's a very funny British comedy routine about that name, because that name implies stability and less risk, when in fact that went belly up. That was the beginning of the end. So now we have stable coins, which can be depegged from the currency they're tied to. And if it can be depegged, if there is a run on a cryptocurrency at one of these, whether it's a regular bank or a shadow institution that is lent and then sold to other people, if there's a run, the US dollar, if that's the peg, it declines as people start selling the actual assets in order to get the money to pay off the people who are running. I just see calamity coming our way. I realize you can't time it, but why do we allow it?
I don't know why it's allowed. I mean, I guess because people are greedy, and everyone thinks it's kind of like there's like a famous Warren Buffett quote about this, right? Like everyone's dancing at a party, and at midnight, everyone still left at the party is going to turn into a pumpkin, and everyone's like, oh, well, we'll just leave the party before midnight. But the problem is there's not a clock on the wall, right? So you don't actually know when midnight's going to strike. I think it's allowed because people just think they're going to be able to get out before all the bad stuff happens. But again, even in the financial crisis, there was people yelling about that for years before it played out. Years. And even right now, like, let's suppose that your assessment completely plays out, right? Let's suppose that it does.
Well, this is something you were talking about on another podcast with some other people,
right.
But we're not the only ones talking about it. This is a discussion going on
right.
about, here we go again.
Right. Anytime you're issuing a lot of debt and leverage to buy risk assets, like it's a recipe for disaster eventually. The problem is when does eventually actually occur? There's a scenario where we get a bear market in 2026, and people think it's like, quote unquote, the big one. And then maybe it's not. Maybe we then rally again in 2027 and 2028, and then we get a big crash, and then it all unravels. I think, like, obviously there's right to be concerned about that stuff. The problem is no one knows when it's going to happen.
Do you think it's a mistake, the Genius Act and the stable coins, and then using cryptocurrencies as leverage in order to get more stable coin? Is that a mistake? Should the regulators have not allowed this?
I'm not gonna like say outright it's a mistake. Like I haven't actually like read the whole thing to know if everything in it is a mistake or not. I think it's risky and dangerous to use those types of products for a lot of people. But I also, the more I've been in markets, the more I've realize that, things are going to happen regardless of whether they make sense or not, and it's better to trade the market that you have and not the market that you want. So that's the way I operate. I couldn't tell you why people take on debt to buy risk assets, but I know some people have done really well doing it, and then most other people have lost a lot of money doing it. I couldn't tell you why people do it, but people do it, and it has effects in the markets. It drives markets for long periods of time.
It's the contagion, though, that affects the rest of us. How do you protect yourself from the contagion? Do you hold hard assets, traditional old boring real estate or gold or not?
So I mean, I'm not like, I do own my house, and whatnot. I mean, I do have a little bit of real estate, but I'm not like into, I don't have a lot of real estate that I'm like renting out to other people or stuff. Like honestly, I just don't have the time or capacity to even want to deal with that. I'm pretty bullish on commodities like gold and silver. I think they're going to keep doing really well. Even if you look at what happened in April to gold, it dropped, but it actually recovered to all-time highs way quicker than the stock market did. I mean, it got to all-time highs within just a few days. It took the stock market several weeks to get back to all-time highs. So I still think we're in a phase where it makes sense to be bullish on commodities like gold and silver. I think palladium looks like it's building out a really good base right now. Copper just got hit a lot recently, so that's kind of got my attention. I mean, people still need it for stuff.
The exception from the tariffs.
Right, yeah. I mean, after the announcement of like 50% tariffs or whatever, it got a pretty big drop, which to me might seem a little bit overblown. I wouldn't be that surprised to see copper maybe get a bounce back here in a few weeks. So I would say those are ways. I also, if you go back to that modern portfolio theory tool, if you add US dollars into it, it would actually, if you're looking at a portfolio consisting of Bitcoin, ETH, and US dollars, it actually suggests about 1/3 cash, just to have on hand. And the reason for that is because you do get these like 70 to 80% drops, and 70 to 80% drops are brutal, but they're not as bad if you have some cash on hand to actually buy it when the drop occurs. The worst feeling in the world is watching the market drop 70, 80%. And you were fully long at the top, and have nothing to put into it. So I think kind of like a mixture of the way I protect myself is I have a mixture of things like gold and silver. I also have some T-bills and CDs and money market. Some cash in like a money market account in case there are big drops in the market. I have liquidity that I can use to get in, like back in April. I do have a little bit of real estate, but not really a whole lot. Those are the main things. And also the other thing is I actually own more stocks than I do crypto. And the reason for that is because at least in my lifetime, I'm not saying it can't happen, at least in my lifetime, I've never seen the stock market drop 80% like I've seen crypto drop 80% many.
So when you were either in junior high or high school, the market did go down almost 50%. That was the great financial crisis. And then prior to that, it was 35%. Look, I've been through, 87 and then 2000 and then 2008 and then 2020, but I think what we never know for sure. But the ability of the United States and the Federal Reserve to bail us out. I mean, the great financial crisis was a helicopter Bernanke dumping a shitload, forgive my language, of money into the system to keep the catastrophe from happening. I don't think they're going to be able to do that when this next crash comes. So when there is this contagion that we've just talked about, and there is this coming crash that we have both said is probably coming, my question is, oh, fuck, I'm dropping words I shouldn't have dropped. How do I protect myself? Because I don't think the Fed is going to be able to bail us out the next time. I don't think the political will exists to bail us out the next time. What do you think?
I think the biggest risk right now is that we see the unemployment rate go up over the next 12 months. And we also see potentially inflation go up at the same time, which would make it so that anytime the Fed cuts rates, or tries any type of stimulus, the bond market might revolt and say, no, you can't do that, right? Like I think the problem right now with the power, with how things are set up is that, the administration wants lower rates, right? They want to revive the real estate market. They want lower rates. The only way you're going to get lower rates is to first have lower asset prices, right? If asset prices keep going up, you can't actually have lower rates. And we saw what happened in April. when they finally allowed, the stock market to go down, Trump wasn't, he didn't care about it at all. He just said, I'm not really that concerned about it. But we saw after it dropped 20%, he all of a sudden cared a lot about it. But during that time, the 10-year yield and the 20-year yield, they were dropping. So you could argue that had they allowed that to happen, we would be at lower rates right now if we kind of just stayed at lower asset prices. The problem is no politician wants to willingly allow lower asset prices to actually get us to lower rates. So I think the problem I think the way 2026 might go, late 2025, 2026, I think you're going to start to see, a rising unemployment rate the closer we get to 2026. But I could also see a rising inflation rate because of the tariffs. I think the tariffs might cause sort of a spike in inflation. It might not be a durable spike, but it might be a spike long enough to make it so that the Fed might cut, but they might not be able to cut as much as they would really need to because of inflation. And look at what happened when they cut in September 2024. That was when the 10-year bottomed and the 30-year bottomed. When they cut, I mean, a lot of people have this. They're so off base, right? They think that cutting rates leads to lower mortgage rates.
No, it doesn't.
Right? The Fed directly controls the short end, but they indirectly control the long end, right? You know this better than me probably, right? If they cut before they need to, it can send the long end up. So again, I think the only way that that they can actually get lower mortgage rates is to allow for lower asset prices, which is not something they're really wanting to allow right now.
And I don't want to talk about Fed theory. I covered the Fed when I was a correspondent for Fox and at Yahoo. And deflationary spiral is what they fear the most, because getting out of one is next to impossible. That's the Great Depression of the
Right.
1930s. Back to crypto. As we are heading into the end of 2025, the second half, and then the beginning of 2026, I read something that I didn't appreciate till our discussion, which is this correlation between Bitcoin and some altcoins with traditional markets. I always thought that they were not correlated. And in fact, and you alluded to this at the beginning of our discussion, in fact, they are. Doesn't that defy, I'm not dismissing their just basic value, but doesn't it defy logic?
Well, I think that crypto operates as a risk asset, so it would make sense that it would be correlated to something like the Nasdaq, right? Let me actually share my screen.
Okay.
So this is a Pearson correlation coefficient matrix between like total crypto market cap, Bitcoin, Ethereum, BNB, and then also you have the S&P, you have some stocks, you have the dollar, we have gold, platinum, palladium, nickel, and copper, right? So Bitcoin here has a 0.86% correlation to stocks over the last 60 days. If you look over the last year, it has a 0.7 correlation to stocks. And the reason why it's not higher is because in the summertime of 2024 and also 2023, we saw Bitcoin go down while the stock market went up. But then there's other times where Bitcoin drastically outperforms the stock market. So it's correlated. You'll also notice that over the last year, Bitcoin is actually correlated to gold a little bit, right? 0.68. It is positively correlated to gold. This is not always going to be the case, right? Like it's the case this year. I think there's probably going to be less of a correlation between Bitcoin and gold in 2026. So it's important to remember that. But when I look at something like this, if you just look at say crypto, Bitcoin is positively correlated to basically all the altcoins. Right? And the reason is because if Bitcoin goes up, it's going to lift the altcoin market with it. The problem, as we said earlier, is that who cares if your altcoin went up 10% if Bitcoin went up 100, right? Like, it's bleeding to Bitcoin. And so that's why if you're in crypto, it makes sense to basically just stick with Bitcoin. Occasionally, I sort of branch out to Ethereum at the right time, but I think it makes sense to mostly stay with Bitcoin. And I don't really have another answer. I just think that you can see that it is positively correlated to the Nasdaq, to the S&P. Bitcoin behaves like a risk asset, not a risk-off asset.
You've given our 4 million monthly active users a lot to consider. I want to wrap up with you with the first of a couple questions as we do wrap up. Whatever happened to NFTs, and does their story have any implications for cryptocurrencies, especially the altcoins?
Well, I think it was a fad, right? I mean, every few years something pops up. This cycle we had, the meme coins on Solana that were pretty popular, and that was when we saw Solana outperforming Bitcoin for a while. That's kind of come to an end now. Same thing happened for Ethereum last cycle. It was just through the lens of NFTs. And then the cycle before that, it was ICOs, right? Initial coin offerings in 2017. Every cycle has something different that people, will focus on and think is the next big thing. But it ends up, a lot of that ends up being distractions. I'm not saying that all NFTs are necessarily bad. There might be some that have done just fine, but you have to be careful. It's just like crypto, right? I mean, just because 99.999% of them are likely going to zero doesn't mean that all of them necessarily will, right? There could be a few. In this case, with crypto, Bitcoin is the one that you would probably want to bet on long term if you had to pick one, right? Like if someone made you pick one and they said, hey, here's some money, put it into a cryptocurrency, and then you get to pull it out in 30 years, what are you going to pick? I think you have to pick Bitcoin because it has the best chance to survive, right? The way I think about it is this: if Bitcoin survives, it doesn't mean that altcoins do, or at least all of them. If altcoins survive, it means that Bitcoin did. Because if I think Bitcoin is the best, so if it doesn't survive, it means nothing else will in crypto. So that's kind of how I would think of that.
And what's the final thing you would want to share with the people who are watching as we head into, you've hit upon what to look for in 2025 and 2026. Anything else you want to leave them with?
Yeah, I mean, I would say just, be a little cautious going into the back half of 2025 with crypto, just because normally it tops out around that time. Best case scenario, according to history, for altcoins or the market in general will be like January of 2026 would be like kind of best case scenario. Worst case is, I guess any moment, right? But history would say, over the next 2 to 3 months, it makes sense to start being a little cautious. And then I think a good thing to do in 2026 is, just kind of enjoy your life. Let the markets unfold how they unfold. I think there's a good chance you'll see some big retracements in 2026. And then perhaps if you want to get into crypto, and you've been nervous and you feel like it's too late this cycle, and if you want to wait until next cycle, the timing would probably be about 1 year after the top. So whatever month Bitcoin tops at, wait a year approximately, and that usually ends up being the bottom for the next cycle. And again, it doesn't necessarily mean we can't have a big catastrophe, but if you're just trying to look to see like, okay, does it make sense to take the risk now for the next cycle, that the timing, if I had to guess, would probably be the end of 2026.